Today we're diving into the wild world of naked price action, where we strip the charts down to their essence and focus on the only thing that truly matters: price. Forget indicators that look like Christmas lights. This is trading at its simplest and best. So stick around, because by the end of this you'll know how to spot these patterns, understand the psychology behind them, and make trading decisions that might just make you say, "Why didn't I trade like this before?" All right, grab your charts and let's get into it. Signal number 1, the fake out. The good old fake out, the market's version of saying, "Just kidding." A fake out or failed breakout happens when the price breaks through a key level, only to immediately boomerang back into the range. Think of it like someone boldly stepping out of a door, realizing it's raining and rushing back inside. Here's an example. Imagine we're in a bearish market where price is bouncing between a clear support and resistance level. Like a ball in a pinball machine. Everything seems predictable, right? Resistance holds, price drops. Support holds, price rises. It's all smooth sailing until it's not. Suddenly, the market breaks above the resistance, and traders everywhere are shouting, "Breakout." But hold on, the price doesn't hold above that level. Instead, it snaps back into the range faster than you can say, "Bad trade." That, my friends, is a fake out. Fake outs in the markets are like the market's way of saying, "Gotcha." But they're not just jokes, they're signals. When they happen, they often reveal hidden momentum, showing us where the real action might be next. So pay attention. Spotting a fake out can save you from chasing bad trades and set you up for smarter moves. Here's another example of a ranging market where things get interesting and a little tricky. Picture this. Price is happily bouncing between a strong resistance at the top and a solid support at the bottom. Resistance holds, and price pushes down. Support holds, and price bounces back up. Everything's predictable until the fake outs start. First, we get a minor fake out. Price pokes above the resistance, but the second candlestick closes right back inside the range. Easy to spot, right? The market was just teasing. But then, the real drama unfolds. Price aggressively breaks to the downside, creating what looks like a strong breakout. Traders get excited, thinking, finally, the range is over. But nope, it's another fake out, and this one's a sneaky trap. Price closes outside the range, a classic breakout signal, but then zooms back into the range like it forgot its wallet. Now here's the kicker. Price goes back to retest the level it just broke. At this point, we might think, okay, this is it. The real breakout is coming. But this is where it gets tricky. It's crucial to use a tight stop loss here, because the market can easily fake you out. The lesson? Fake outs in ranging markets aren't just market tricks. They're tests of your patience and strategy. By staying cautious and keeping your stops tight, you can navigate these traps without losing your cool or your account. All right, folks, let's talk about one of the most iconic chart patterns in the trading world. The double top and double bottom. Think of these patterns as the market's way of saying, "I'm tired, I need a break." So, what exactly is a double top? Picture this. The market climbs up, tries to reach new heights, but suddenly says, "Nope, that's too much cardio for today." It forms an M shape, signaling a reversal. And a double bottom? Well, that's the market falling, bouncing back, falling again, and then deciding, "All right, enough is enough, I'm heading back up." It forms a beautiful W shape that traders love to see. How do we trade these patterns? The traditional way is to wait for the price to break the neckline. Basically, the market yelling, I've made up my mind." But here's the catch. Entering after the neckline break often means a huge stop loss. Nobody likes a stop loss bigger than their weekend grocery bill. Am I right? The smarter way, patience. First, wait for price to retest back to the neckline, and then we enter with a buy order. Simple, right? Here's another smarter way. Enter with Fibonacci magic. And here's how we optimize. Wait for the neckline to break. Patience, my friends. This isn't a sprint. It's a marathon. Grab your Fibonacci retracement tool. Think of it as the market's measuring tape, accurate, reliable, and super stylish. Map it from the start of the move to the end, and set your entry at the 618 retracement level. Why 618? Because Fibonacci said so, and who are we to argue with a math genius? We then place our buy limit order at the 618 retracement level, and we wait. Right here we see that our buy order has been activated. Perfect. This is one of the safest ways to trade the double top and bottom signals with minimal risk. But wait, there's more. Some of you are thinking, but what if the market dives deeper after I set my retracement? Do I need a crystal ball for this? No, just keep adjusting the Fibonacci tool to the latest move. Trading is like life. If things change, you adapt. And remember, if the price hits your target before pulling back, just shrug it off and say, the market didn't deserve me today anyway. The power of rejection, no, not that kind. To make your entry extra spicy, look for candlestick rejections at the 618 level. It's like the market giving you a nod and saying, okay, let's do this. Risk management tips. Now, here's where you channel your inner risk manager. Always set a stop loss below the previous low for double bottoms or above the previous high for double tops. And please don't go all in on one trade. Remember, the market can humble you faster than a dad joke at a family dinner. So there you have it, how to trade double tops and bottoms like a pro using the Fibonacci retracement. And if the market doesn't cooperate, just take a deep breath and remind yourself, it's not me, it's you, market. Now let's dive into the fun part, looking at some of the best and painful double top and double bottom trading signals. Get ready for some what to do and what not to do moments. The best double top and bottom signals. The picture-perfect reversal. First up, the textbook perfect double top. It's like the market is saying, watch me nail this reversal, no questions asked. The price forms an M shape, hits a key level, fails to break higher, and then, bam, breaks the neckline with conviction. Price retraces back to the neckline, and the neckline holds perfectly as a resistance, and gives us a beautiful selling opportunity. Let's take a look at another example. The price formed a really nice M shape, with a neckline here. When this happens, all you need is your Fibonacci retracement tool, a confident entry at the 618 level, and the patience of a saint. This setup practically whispers, profit is coming, my friend. The painful double top and bottom signals. Picture this. The price forms what looks like a double bottom, breaks the neckline, but instead of reversing, it turns around and skyrockets higher. Painful, right? This one's a heartbreaker. But here's the lesson. Always wait for confirmation. If the price comes back and doesn't respect the neckline or the 618 retracement, it's probably not a real reversal. Consider this a trading red flag. Unless you've got big pockets, then by all means, jump in early, hold on tight, and pray the market decides to reward your boldness. But let's be real. If you're not rolling with big pocket energy, playing it safe is probably the better move. As they say, fortune favors the brave, but it also occasionally laughs at them during a stop out. Remember, traders, when in doubt, zoom out, look at the higher time frames. Check for confluences like trend lines or Fibonacci levels, and don't let FOMO drive your decisions. And there you have it, folks. The art and science of trading double tops and bottoms, complete with the good, the bad, and the downright hilarious. Remember, trading is all about patience, strategy, and occasionally laughing at yourself when the market humbles you. Whether you're a conservative trader waiting for the perfect setup or a big pocket risk taker diving in early, the key is to stay disciplined and learn from every trade. Thank you for tuning in. If you enjoyed this breakdown, or if you've ever been betrayed by a double top or bottom, be sure to like, subscribe, and leave a comment below. Let's hear your stories, lessons, and maybe even a few trading war stories. Until next time, may your profits be high, your stop losses be tight, and your double tops and bottoms always hit the target.